much. It's a privilege to be here. As you guys know, I'm another one of the group of victims that have fallen into Bob's gravitational field over the years. And it's a privilege and an honor to be part of this circle, and in particular of this community. One thing I've told Bob repeatedly over these 2 years in which we've worked together is how rare this community is. And it is the reason why we've started this project. So we're going to talk about adaptation, as Bob said, in particular about adaptation in our financial systems. So we're going to talk about insurance, one of our favorite topics. I've been working in the insurance industry for now about 20 years, in particular developing new products in the space. And as you know, we're witnessing quite a bit of stress in the financial products that we use to insure ourselves. And this is, of course, a product of all the climate effects that Stuart described. And now the question is, how do we adapt our systems to work better for us? So I hope you find it interesting. We come this time with reinforcements. So I'm accompanied by several colleagues, as Bob said, from the University of Michigan. You'll meet them in a second, as well as by one of my colleagues who has done quite a bit of work on the technical side, focusing on Sarasota. So she's going to present to you a series of products that we have developed as prototypes within this new realm of products that we call parametric insurance. So you'll see them in a second. I wanted to advance to you that, I've been here at this podium a couple of times talking about these products as a theoretical offering. But this time, we come here with some more tangible ideas or offerings. So I have discussed with people in the industry whether we could actually implement some of the things that you're going to see in a second. And the answer is yes. So even though these are still early days, if you see throughout the presentation anything that you think, if these were available, I would like to implement this or buy this product, please tell me. It is not my objective to come here to sell you insurance, but if you want to or you have interest in some of these more novel options, please talk to me later. The reason why we're here in particular this time is to present this new research project. And the reason why we have engaged in this research project with Bob is because of you, because this community, as I said, is a rare event. We talked to many towns throughout the US about adaptation, finance, insurance, and so on. And it is very anomalous to see a community that is so engaged and so interested in the topic. The testament is the questions that you were just asking. And that's why I told Bob, look, why don't we, all these ideas that we have, why don't we do a formal research project and we use Sarasota as an innovation laboratory for all these new insurance products. So I hope that it inspires you to participate, and there's going to be ways to participate, give your opinion, ask your questions, as we will introduce in a second. All right, lengthy introduction, but let me go into the topic. So I don't think the insurance products that we have currently in the industry are bad per se. We're seeing, of course, an increase in pricing. You're very familiar with that. But more concerning is, in my opinion, the retreat of some products. There are some areas in the US where insurers are no longer offering products. And this is a bit of a surprise, right? Because we've considered these products a commodity. The fact that US residents of different communities, maybe for the first time in a long time, cannot access insurance products that we thought were a given, puts us a little bit on par with some areas of the world that have never had access to these systems because they had underdeveloped financial mechanisms. That was the inspiration to start looking at mechanisms that people in other settings, in other countries, in other times have used to transfer their risks. That was the genesis of this project that we started thinking about 3 years ago. And it relies on the community. But the main point is that the products that we have, that you are buying currently, that I am buying currently in New York, that our friends are buying currently in California, They're not bad per se. They may be insufficient to tackle the challenges that Stu just described that are coming, right? So what we want to investigate is how do we complement them with other products that could help us adapt better. That's the motivation. Now, I'm going to talk a lot about a type of insurance company called a reciprocal exchange, and I'll tell you how it works. This is not a new mechanism. It was invented or created in the 1800s by a bunch of companies in New York who were buying insurance from Lloyd's from London, and at some point they realized that Lloyd's of London was charging them a lot of money to insure their risks, while they were having a lot of cash in their coffers, enough to insure themselves. So they banded together and they said, why do we buy insurance from these external people who do not understand our exposures, our business, our assets? Why don't we buy insurance from one another? Why don't we cover each other's backs? And that gave rise to this new mechanism that is called a reciprocal exchange. It is an organization in which participants sell insurance to one another, and you will see the benefits of that mechanism. So even though it's a very old mechanism, and there are many reciprocal exchanges working today in the US, some big companies that you're familiar with, like Farmers and others, USAA, they are reciprocal exchanges in their structure. So this is not novel. The novelty we're introducing in this project is the capability to buy parametric insurance, these new products that Laura will describe in a bit more detail in a second. But the philosophy of this is that it is a product where the participation of the community is paramount. And this is important for 2 or 3 reasons. The fact that the community builds these systems means that the community has more power to determine what products it sells to itself. Meaning that because the community determines the product, they are not at risk of losing access to that product. To me, that's one of the most important benefits, right? So this risk that the insurer, this third party, will not renew your policy because they're not selling a product anymore, kind of disappears or gets mitigated because the community itself wants to continue protecting itself, right? The second very important element in all of this is that it increases the motivation in the community for risk mitigation. We cannot ignore that the fact that insurance companies are not reducing our prices, that they're retreating with their products, well, our communities have some responsibility for that too, right? Because we're not mitigating our risks. We keep building houses at 3 feet of elevation next to the water. I mean, at some point, as a community, we also gotta say, no, we're not gonna allow that anymore. So the fact that you're insuring yourselves gives you a direct motivation, if you wanna save your money, to avoid those risky behaviors. And this is something that we need to learn progressively. So it is a community-centered idea. Now, I want to briefly give you an overview of how an insurance system works. And probably all of you know this, but just to recap, when you are an insured, you pay premium. You pay premium for a product that the insurer offers to you. And you have no say in how this product is built. I mean, hopefully the insurance company is building products that we like, that we need, that are helpful, but we really have little influence in how these products are developed. So typically, they are developed with the insurer's interests in mind as well, right? But we pay premium, and this premium moves to the insurer. The insurer uses this premium in 3 different ways. It has to pay operations. Running an insurance company is very difficult. So, there's a lot of people involved in processing claims, in calculating risks, in fulfilling regulatory requirements. It's a complicated endeavor. So some money has to go to that. Second, they pay reinsurance, meaning because they're insuring us, they are accumulating a lot of risks, they're accumulating a big portfolio, and they also are afraid of losing a lot of their reserves. So they buy reinsurance to help them cover losses when they happen. But the rest of the money, and by the way, this is very simplified, right? It's much more complex than this, but this is at a very basic level what's happening behind the curtain. The rest of the money is invested. Typically, it's invested in high liquidity instruments. so US Treasury bills and things like this, that allows the insurer to retrieve this money whenever they need it. And they might need it, right? Because they have to use this money to pay claims. But this is giving them an additional, well, the money in operations is lost, right? This is a cost, so it disappears from the picture. The premium they pay to reinsurers is also a cost, so it disappears from the picture. But the investments generate a little bit of money, right? And actually, this is most of the revenue for the insurer. This is what they put in their pockets, right? This is what goes typically to stockholders of the company in the form of dividends. And this is how they make money. Most of the money insurers make is not because of the premium that you pay, it's because of the yields of their investments. Okay, so what's happening when there's a claim? When there's a claim, there's another entity involved, an adjuster. This adjuster is responsible for determining the losses to your property, right? But remember that this adjuster works for the insurer, right? And if the insurer is good and the adjuster is good, then this process is great. And I've seen many times this process working great. You know, in Chile in 2010, there was an earthquake. The Maule earthquake was a very big earthquake, and I was working with the insurance industry there. And they prided themselves in responding to all the claims successfully in less than a year. There were no complaints, or minimal complaints in that. And you know, they had to work with a population that was very large and affected on a big widespread area from this earthquake. So this process can work very well. However, we hear and we read in the newspapers constantly of examples where this process doesn't work. And when this process doesn't work, it erodes our trust. And that is a problem, because then we start equating the insurance product with something that is not guaranteed to help us. And that is a pity, because the insurance product is a great product, right? The insurance product is supposed to substitute large losses in the future for small losses every year, our premium. That is the purpose, and it is magical because it allows us to invest, it allows us to move through life with confidence, it allows us to acquire assets. And when that process doesn't work and we lose our trust, we lose a lot. Now, when there's a claim, the insurer may, in its turn, issue a claim as well to the reinsurance. So they get some money from the reinsurers. But they also have to sometimes call on their investments, right? So this money, if everything goes well, goes to the insured and the claim is satisfied. Good. Now, in all of this process, I'm putting the crown here on the insurer because, as you can see, the insurer has control. The insurer offered you the product, the insurer collected your premium, the insurer collected the investment yields, and the insurer hired the adjuster, and the insurer made sure that you got your claims. So, you know, the system, this is how the system works. The insurer is mostly in control of this process. Now, how does a reciprocal exchange work? It works a little bit differently. As you can see, there is no insurer now in the picture, right? So it's just the insured. And when you see one person here, it's not one person, it's a community. It's many people together, because it doesn't work if you do this by yourself, right? Doing it by yourself is basically self-insuring, and that is volatile. It may work for you, but you are subject to a lot of randomness, uncertainty in the process. You may be lucky and not experience losses, and then you keep your savings, but you may be unlucky and experience a hurricane and lose everything, right? So you need to do it as a community. It's the only way this works. Now, the insured, in this case, needs help. Remember that managing an insurance system is complicated. So they need another entity. This is an entity that takes care of the operations of the exchange, setting a good pricing for the product, designing the product, making sure that this product is acceptable to the community, managing claims. All of this stuff still needs to be done by someone. But in this case, these operations are carried out by an entity called an attorney in fact. But the big difference with the system from before is that this attorney in fact is an entity hired by the insureds, by the reciprocal itself. So now this entity works for the community. It's a very big difference. Now, because this entity works for the community, it means that the community has a direct impact, a direct influence in how the products are shaped. And this is crucial in my view, because when the community says these current insurance products that we're buying are not fulfilling our need, this is your chance to say, we're going to do something different. And it is that element is a big part of this research project that I will describe in a bit more detail in a second. But it is your chance to say, hey, this is what I need from my insurance, and this is how I would like it to work. You can do this in this mechanism because the entity that is manufacturing these products is hired by you. Now, what happens then with your premium? Well, you have to pay these guys, right? You have to pay the guys who manage the operations, and that's a cost. Just like the insurer did with their internal operations, you have to pay these people who are doing this job for you. You also have to pay reinsurance because you don't want to lose your investment. So you have to protect them at a community level through insurance. But note that now you, as a community, are interacting with the reinsurance markets directly. This is an advantage because maybe there is an attractive price level at the reinsurance level that you're not seeing right now because you're acting through the insurer. It gives you access to another level of the risk transfer chain. And then the rest of your premium gets put into an investment, just like the insurer did, which means that once the costs are taken out and you've paid these guys the attorney in fact, once you've paid your premiums for reinsurer, you have a new bill there that is created by the investments, a new yield, and now this goes back to the community in the shape of dividends. It goes back into your pocket. Now, this is a mechanism to reduce your premium over time. At the beginning, as you can imagine, because you have not accumulated enough money as a community, you don't have surplus, you don't have reserves to cover losses. So you're gonna have to pay even more than what you pay now in premium because you have to start accumulating this pot of money. But over time, because that dividend that you put in your pocket increases if there's few losses to the system, that actually automatically reduces your premium. It's a discount, if you will. And you can participate in the market directly through this mechanism. If somebody has to pay in California 30% of premium, by the way, these prices are real. Some companies are paying 30% annual premium. So if you want, $3 million in coverage for wildfire in California, some companies are paying now $1 million in premium, right? It's brutal. So companies are saying, why are we doing this? Why don't we just put this $1 million into an account and we insure ourselves through this mechanism, okay? So you put that money into your pocket and over time you reduce your premium. Now, what happens when there's a claim, right? The reciprocal exchange has to respond to claims. Well, there's an adjuster as well. Somebody needs to determine what the loss was. Now, you see that below the word adjuster, I've written algorithmic. And this is one of the big differences that we are espousing here with this particular project. Reciprocal exchanges work also with traditional products. You can have a normal adjuster and send the adjuster to your homes and get the claim and so on. But the fact that we now have algorithms and remote sensing mechanisms that allow us to estimate what the damage to the community will be if a hurricane approaches, allows us to create these new products, these parametric insurance products that Laura will tell you more about, which means that this adjuster that you see there, it can be an AI engine, can be an agent, can be a person looking at a table. Everything is very transparently written. In your contract, there's going to be a table that says if the category of the hurricane was 4, you receive 80% of your insured limit. If it was a category 5, you receive 100% of your limit. So there is no time spent in determining the loss, which means you get your money in a matter of hours into your bank account. Companies, large corporations, governments buy these products all the time. In 2024, we sold $1 billion in limit for governments and corporations. They value these products. Why? Because they can get money very quickly after an event to respond to their emergency needs, response. We have a company who buys this type of product to protect their operations in the Philippines, which, it's an offshore center for them, difficult to access, difficult to communicate. If there's an earthquake or a hurricane there, they can shift money there immediately in a matter of days to help their operation there, right? So these products have utility. One of the objectives of this research that we're starting here in Sarasota is to see whether these products are interesting to this community. So we'll ask you over these next coming months, we'll give you plenty of opportunities to participate in workshops, in meetings with the team of University of Michigan, which I will introduce in a moment, to give your input as to how do you see these products working for you, if at all. Maybe you say, no, this is not what I need, right? But we want to investigate that angle. But the point is that this adjuster, which is algorithmic, is really a part of the attorney in fact, which, remember, you have hired. And this adjuster will tell you how much money is allocated to you for that particular claim. Now, the investments, of course, are used to pay claims, and the reinsurance proceeds are used to pay claims, just as before, right? But now, you see that the crown now passes to the insured. You, as a community, have played a role in designing your product. You have hired the attorney in fact. So if you don't like them, you can hire another attorney in fact. You have influenced how the adjuster will behave, because it's a table, it's an algorithm that you can help define with the help of your experts. And this is why we're partnering here, of course, with Bob at the CSC, but also with Florida International University to serve as an independent partner in evaluating the goodness of these solutions for the community, right? So we want to make them transparent. We want to make sure that they work for you. All right, so what are the advantages of these systems as we see them? And again, we want to explore some elements of these have not worked in the past. So we wanna study where the frictions are, where the use cases are. And this is part of this research project that we're starting now. But in general, from a reinsurance perspective, as I said before, it gives you access to a new layer of risk transfer, new pricing, global companies that are transferring risks. It gives you control over your investments. It gives you control over the adjuster, so you know what claims are going to be paid in what scenarios. It gives you ability to hire your attorney in fact as you see fit. And also importantly, there's two elements that we have to be careful with, and this is part also of the research. One, it gives more responsibility to the community. So this is an added burden. Now you're responsible to curate your own insurance company. And just as you get benefits from it, you're going to get dividends from it, you also have a responsibility. You have to organize, you have to make decisions, and as a community, you have to decide. And this is one of the reasons I told Bob Sarasota was perfect because of this community, because you are already engaged, you are already interested. So I thought it could be a good laboratory to start studying these options. And also, one caveat that we will emphasize in the next moments when Laura presents to you the solutions, these parametric insurance products are not perfect. They have a wonderful ability to pay fast, to pay transparently. You can use the proceeds to do whatever. I mean, there's no strings attached in how you can use the money. Some insurance products only allow you to repair your house, your roof, your car, whatever it is. But maybe you need money to restore your groceries because you lost power. Maybe you need money to evacuate. Maybe you need money to pay for a hotel. Maybe you need money for any other stuff. And these products allow you to do that. However, they're not perfect in the sense that maybe a category 3 comes along, it causes a lot of damage, but it was not enough to trigger a large payout according to this algorithm. So again, we need to design these algorithms well so that they are accurate, so that they respond as we expect them. And we don't think this as a substitute for traditional insurance. We rather think of it as a complement. Remember that for adaptation, we're going to need an artillery of financial products to help protect ourselves. All right, so let me go to the particular project, and just to give you a bit of a map of how we're going to proceed. So phase 1, well, by the way, there's 4 institutions involved. Guy Carpenter, the company I work for, we're a reinsurance broker, and I'm the head of research, so I have the luxury of going into all of this stuff that is new. So Guy Carpenter is supporting with a little bit of money this project, and of course with the time of our team. The University of Michigan, you will meet Sabine in a second, will be responsible for stage 2. All the coordination will be done with the Climate Adaptation Center, with Bob and his team. And as I mentioned before, towards the end of the project, we'll have Florida International University also give their input as to the quality of these parametric products. This is kind of chapter 1, but we have already aligned a community in California of interested researchers to expand this reciprocal research to California. Why does that make sense? Well, because all of you here are subjected to the same risk, hurricane, right? So there's going to be a problem with diversification. If the reciprocal here loses money here, then you all lose your investment. However, if you partner with other communities across the U.S. that are subjected to different perils, and they're undergoing the same stress that you are undergoing here, but for wildfire or for earthquake or for severe convective storm, if you partner with these other communities, you increase your diversification, which means that you reduce your risk of losing large portions of your investment, right? So they're already waiting to see what happens in Sarasota to establish Chapter 2 in California. Now, the people involved, you know Bob already, you know me already, and you're going to meet Laura in a second. She's going to give you an overview of these products. And then I want to introduce Dr. Sabine Lewis, who is here from the University of Michigan with Margaret Miles, and she's going to tell you a little bit about how this second stage of the workshops and the interaction with the community will follow. Sabine?
Perfect. Thanks, Guillermo. Hi, everyone. How are we doing? Great. Okay. Oh my gosh, a response. That's amazing. I feel like I get that half the time, so this is super exciting. We can advance to the next slide. Oh, that's me. I'm advancing. Okay. All right. Oh, I did too. Okay, great. Who am I? I am Sabine Los. I'm a faculty member at the University of Michigan. Michigan, far away from here, but I actually have met some other Ann Arbor residents, so very exciting that there's some crossover here. And what our group does, our team tries to look at a lot of these really innovative solutions like the parametric insurance that Guillermo just introduced, and really work on understanding what your potential excitement about these products are, and also even concerns. And so you're going to see a lot of my face, but also my PhD student, Margaret Miles, she's over there waving at all of you, over the next couple of months. And we'll be asking you, hey, what are you excited about? What's your experience with all of these hurricanes? What's your experience with insurance? What are your concerns with something like this if the city of Sarasota wanted to take a product like this on? So we have this QR code over here on the left, and we'd love it if you could fill out this quick survey just so we can understand a little bit about your background, your interest, your experiences with insurance. Even if you don't ever want to see us again, this would be super useful for us to get to know who lives in this community. If you have any trouble with accessing this survey, please raise your hand and Margaret will come out to you and help you access it. If you're on your computer, you can also type in that link over here, that bit.ly link. If you just don't like mobile phones and you don't like computers or tablets, you are welcome to write down any questions you might have and come up to us after this session, and we're happy to talk with you about that. Okay, so I'm going to take a couple of minutes as you all fill out that survey, and then maybe give me a little bit of a nod or a thumbs up when you're done. And again, raise your hand if you have any trouble accessing this. I was just reminded that this survey should only take a minute for you. The first page of questions is required. Second page is completely optional, but we would love your feedback there. Oh, got to sign out into Wi-Fi. Ooh, okay. We can also bring this up at the end as well. Yeah. Okay. Sure. Put this down.
Bob, you better be filling out that survey. I don't know what you're doing. Yeah. I'll make sure I can find you, so I'll make sure. Okay.
Okay, how we doing? Got it together? I still see folks on their phones. Awesome. So thank you everyone for providing your feedback. We would love to chat with you on any ideas you have or questions or thoughts you have, or just like your experience on living with hurricanes, of course. We'll be around. What we're planning on doing is designing a bunch of different ways of which to interact with you over the next couple of months. So I'm only up here for a short amount of time because I want to kind of get out here, get to know you all, and so you'll see me around for the rest of the day as well. For the rest of this presentation, we'll also have this separate QR code. So you can put up questions that you have about any of the things that Laura is about to mention or what Guillermo has mentioned. So this will be up in the upper right-hand corner. You again can scan it and then just add any questions that you might have. And I think that's it. Am I forgetting anything?
This QR code will be the same QR code that you've been seeing in the corner. So if you don't have a question now, but then you're like, oh man, I really don't understand that, feel free to scan it while the presentation continues as well.
Yeah, awesome. Okay, so I'm going to pass this over to Laura, who will present about the solutions.
Fixed up. Thank you, Sabine. So the goal of the next set of slides is really just to give you a taste of what these types of parametric policies could look like. As Sabine mentioned, if you have any questions, please, yes, this slide doesn't have the QR code, but a lot of them will have the QR code on it. So definitely looking for feedback both today as well in the as well as in the workshops that will be coming up. So Guillermo already gave kind of a little bit of an introduction about parametric insurance, but just to kind of go over this again, parametric insurance is a little bit different than traditional insurance in that the payouts are based on the characteristics of the event itself and not going through this loss adjustment process that could take some time. So what I mean by that, when you think of a hurricane, you might think of payouts being based on whether a hurricane comes within a certain distance of a major city with a certain wind speed or hurricane category. We can do this for other perils as well. If there was interest for a policy specifically for rainfall, the trigger would be based on, let's say, the number of inches of rain or something. But we'll focus on hurricane today. So as Guillermo mentioned, there are certain benefits that come with a policy like that, specifically with the speed and the transparency of the payments. Say the payouts are purely based on the event itself. Those event parameters are typically reported by public agencies. So for hurricane, you can think of something like the National Hurricane Center that's going to publish in a public place where the hurricane has gone, so the position of the eye, as well as the maximum sustained wind speed at different points in time. Also, as Guillermo mentioned, these types of policies are super customizable, so we can target payouts for certain types of events that there might be interested in having payouts for, and the payouts that are received can be used to cover a wide variety of losses, sometimes losses that might be more difficult to cover under traditional policies. Now, on the right, we're going to show a number of solutions that are just commonly used in the industry to cover parametric hurricane risk. So typically these solutions generally rely on setting up some form of shape and checking whether the hurricane that happens crosses this shape. So if you look on the first row, we have things that are called cat in a circle, cat in a box. They're called this because you're essentially checking, does the hurricane have a certain category within this area? So we've set up either a circle or a box around the area of interest, and the first step we take when a hurricane happens is check, did the hurricane pass through this area? If it did, then we proceed with a second step to do some sort of calculation to figure out whether a payout happens. Also on this first row, we have something called a gate solution. Essentially what's done is we set up a line that runs parallel to the coast, and you're essentially checking, does the hurricane cross this line? Essentially, does it make landfall in that area? If it does, then you proceed with the second step of doing this calculation to figure out whether a payout occurs. Now, on the second two rows, of solutions, they essentially build off the ones on the first row. So the first row, you use a single circle, a single box, a single gate. Now when we look at the second 2 rows, you're expanding this area of coverage using multiple circles, multiple boxes, multiple gates. So instead of just checking if the hurricane crosses one thing, you are going to check if it crosses any of these. So to understand a little bit more about how these work, we're going to look at the cat in a circle in more detail. Great, that worked. So we're going to see how an example parametric trigger might respond to an actual event. In this case, we're going to look at Hurricane Milton, which happened last year, as you all know. So on the top, you see a map. And on this map, you'll see a white circle. And that's the coverage area of the parametric trigger, essentially the circle that you've set up around your area of interest, in this case, Sarasota. The track that you see is that which was reported by the National Hurricane Center. So we have the position of the hurricane, the center of the eye, and then the coloring that you see is based on the maximum safe wind speed. So the coloring is the category of the event. So once again, first step we do is we check, does Hurricane Milton cross the box? Yes, it does. So therefore, we go into second step, which is calculation to figure out, does a payment occur? Now, typically with these triggers, what we do is we figure out what the maximum sustained wind speed is within that area of coverage. And that's what you see in this second row. The line that you see is essentially the wind speed that's reported at each point in time. And when you see that red block pop up, that's when the event is crossing that circle, and that's the maximum wind speed in that circle. Now that you can build parametric triggers that are just purely based on wind speed, and you look up a table, but this type of trigger that we've designed takes us one step further. And this type of parametric trigger is kind of like a mini model that, based on the wind speed that's within that circle, it'll predict a loss for the city of Sarasota. And if that predicted loss exceeds a certain threshold, that's what you see in the bottom, we're calling it the attachment, then a payout occurs. So if you see that bottom row, when that Milton hits the circle, you see that loss estimate go from a non-zero value, so no loss, and it jumps up to giving a value. This value exceeds the attachment, so therefore a payout would occur. Typically, the higher above this attachment the loss estimate is, the higher the payout will be. Now, to build triggers like these, we need a lot of data. And although we have a pretty decent historical record, it's not enough storms to understand all the possible events that could affect an area like Sarasota. So for this reason, we rely on a hurricane model where it's possible to simulate tens of thousands of events in the vicinity of Sarasota and understand what the impacts for those events would be, impacts in terms of damage due to wind speed and flooding. So that's exactly what we've done. We've taken a hurricane model, and for each of the events in that model, we've calculated a loss to Sarasota County. That loss being based on damage to all of the buildings in Sarasota, damage being either driven due to wind or flooding, both storm surge and rainfall. So with this model data, we've designed for today a few different triggers to look at. Now, we've just looked at a few that we think are viable alternatives for the city of Sarasota. However, as Sabine has mentioned, definitely looking for feedback. If there's different types of things you'd want tested, questions on some of these triggers, we're definitely looking for that feedback. But for the purposes today, we're looking at 4 different types of triggers. The first 2 being a cat in a circle. Essentially, we've set up 2 circles over the center over the city, one which has a 50-kilometer radius, and one which is a bit larger with a 100-kilometer radius. So once again, with a solution like this, what we'll do is when a hurricane happens, we'll check first, does the hurricane go through those circles? And if it does, then we'll proceed with the calculation to figure out what the loss estimate for the county would be and would a payout occur. The second solution we look at is a gate. We've set up a 200-kilometer line that runs parallel to the coastline around Sarasota. So essentially checking, do any hurricanes cross this line? And if they do, we'll proceed with the second step of doing a calculation to figure out whether payout would occur. Now, this last solution, the Kattner grid, is a little bit different in that instead of just checking one circle or one line, we have a whole collection of boxes. And this allows us to cover a much larger area, capturing more events that might affect the city. And essentially when this happens is instead of just checking whether the hurricane crosses one line or one circle, we keep track of all the boxes that are crossed, what the wind speeds in those boxes are, and use a combination of information to figure out a loss estimate. And once again, then proceeding to figure out whether a payout would occur. And to look at how these work in practice, once again, we'll revisit Milton. Now, the animation you see on the left is exactly what we just walked through for the circle, but now we're adding the response of the gate and the Kattner grid triggers for Milton. So once again, that top row, you see a map, which has essentially the shape that's been set up for the trigger. We have the circle, we have the gate, and then for the Kattner grid, when you see Milton go through, it'll highlight all the individual little boxes that the hurricane crosses. In that second row, you see the wind speed profile of Milton, and when you see the red boxes pop up, those are the maximum wind speeds that occur within whatever shape we've set up. And then in that bottom, you'll notice when Milton enters into those triggers, we have a loss estimate for that event. Now to look at just a little bit more, just the final outcome so we can really see it, a few things you might notice. So in this, we've set up an example attachment for where a payout would occur, just for the purpose of having an example. So you'll note that for all three triggers, the Kattner circle, gate, and the Kattner grid, Milton does intersect the trigger and does result in a loss estimate for the event. And all of those loss estimates do exceed the attachment level of whatever structure we've set up. However, you will note that the loss estimate from these three triggers are different. And this is important because this will ultimately affect what payout would occur. Now, because we see these differences, it's really important to thoroughly test all of these triggers. So we'll go through a couple of tests that we've done. So the first is just to expand on